Yo, what's going on, guys? We're here again with another video. Really excited about this one. In today's video, what I want to talk about is simplifying what an order block is. What I'm seeing that people are having issues with right now in the niche, and from the questions we're receiving right now, is people are having trouble identifying what order block to use, which one to actually trade off of, what actually is an order block, how to trade these institutional candles, and how to maximize the way you can trade these and profit off of them. So what we're going to do is we're going to go to the charts. I'm going to be breaking down some of the questions that a lot of you guys have about how to properly trade these institutional candles. Lastly, we're going to kind of go over some secret tips and tools that we like to use here at TradeStar Strategies that help us win on a day-to-day basis using these institutional levels, order blocks, point of interest, whatever you want to call them, right? So let's go ahead and hop on the charts. Let's go ahead and hop on in to what an order block really is. There's a few different variations when it comes down to order blocks. There is a bullish order block, and then there's a bearish order block. So your job as a trader is just going to be to simply understand the difference between the two and really what an order block truly is. So we can go into the definition of what it is. For me, simply put, it is a buy to sell candle or a sell to buy candle. Now, what does that mean in reality? It means that if my true move is to sell, I have to buy first. If my real move is to buy, I got to sell first. Even that can be a little bit hard to understand. So let's just draw out a little example of a market, and let's talk about how to identify an order block. So let's say we have a market that looks like this. So one of the key things that I like to say, or the key characteristics of an order block, it is a candle that makes a move to grab some type of liquidity before having an aggressive move in the opposite direction. So let's say in this example, we have a bullish candle right here. And then to the left of this example, let's just zoom in really quick. So what we're going to say is on this candle, this is going to be our buy to sell candle, right? So this is where an influx of buying orders gets put into the market, right? What we have to understand is for bigger institutions and larger players in the market to be able to place a position, they have to hedge, or they have to pretty much just hedge into their position. What does hedging mean? It means buying and selling in the same area at the same time. Now, what we could say is, in this example, let's just say we're buying here, right? So what happens is basic retail concepts teaches us here that, hey, we have a double top, so we should try to sell here somewhere, right? Price made a high, we should try to sell the next high, right? And then let's say basic retail tells us to take profit down here somewhere, right? And then we're always taught to put our stop losses above the high. So here's the highs. Let's say we put our stops right here. So there's two things that are happening that are occurring in this area. The first thing being is there's people that are selling here. So they're selling here, they're expecting price to go lower, right? So even if the sell goes into a little bit of profit, it's enticing traders to keep selling, and then price goes up, and what happens is it's forced back up to grab liquidity. We can say that liquidity is people's money, their buy stops, their stop losses, their stop orders. We can say that right here, we have a number of different things. Let's label those out just so you have a good understanding. The real geniuses in the market, what they like to do is they like to put above every old high and below every low. They're taught that, hey, if the market breaks up above a high, it should just keep going. So these geniuses are putting buy stops here, stop losses down here somewhere, and they're trying to take trades on these breakouts, right? So what's happening is we're enticing or inducing two sets of traders. We're stopping out the sellers by creating this big buy to sell movement. So what happens is these larger players in the market, they're able to identify based on a number of different things where the liquidity is sitting in the market, right? They build up liquidity points just so they can come and use that liquidity to enter in their true position. So let's get back to this example. So right here, we have a buying position. In this example, let's say we buy 1 million lots here. What's going to happen is interjecting that much volume into the market is naturally going to force price up. Now, once they force price up, what's happening? They're triggering the buy stops and they're they're hitting the sell stops, the stop losses. So the stop losses are getting hit, and they're practically just taking that money and putting it into the next order, right? So they're coming up here, they're pushing price into a premium level so that they can come up here and they can, you got it, let's say sell. Let's say they sell 4 million lots. Now, what we got to take away is now we have an open buy position and a sell position. What these institutions do is they have to hedge their positions, but they can't affect the natural order flow of the market. What does that mean exactly? I'll give you guys an example. I'm going to go to GBP AUD on Owanda's data feed. I'm going to go to a daily time frame. I'm going to scroll back in time. So notice this, guys. Notice that this is a daily time frame, and there is a huge random spike right here, right? Now, what happens is these banks and institutions, they get charged millions and billions of dollars of fines for manipulating price or becoming market makers. So when they're entering their positions, there has to be a certain amount of buying pressure and a certain amount of selling pressure to keep the market in natural order flow. Otherwise, what happens is if you interject millions and millions of dollars worth of pressure into the market, you're going to have these unnatural spikes. This is 1,000 pip spikes on the daily time frame. This probably happened in less than a minute. We can come back here. Here's another one, right? Look at this. This is an old example, buy to sell. This is what happens when you don't buy to sell or sell to buy. When you interject this volume into the market, you get an unnatural, unhealthy spike. What that does is it messes up world trade, world economies. You guys got to factor this in. This is the actual price of currencies versus other currencies. And it affects a lot of different industries and markets all at once, right? When people manipulate price. So what we have to factor in is that if this buy position right here is open, price goes up, they could be up so much profit, millions of dollars, hundreds of thousands, whatever, but they actually hold this buying position. And then as this sell, as it starts going down into profit, what happens is this buying position right here, this starts also going into drawdown. Eventually, let's say we come to an area where we're taking profit. Let's say down here, they're closing their position and they're taking profit, right? What's going to happen is this buying position is still open. These larger players in the market, they have enough money to hold drawdown for long periods of time. But eventually what's going to happen is this pent-up buying pressure is like a magnet. And what's going to happen is the market's going to pull right back up to that specific candle, and it's going to potentially mitigate. What does mitigate mean? It means to break even, take a small loss, take a small win. It means to close a previous position. Now, when it comes down to this candle, for example, we don't know where the actual volume is lying in this specific candle, right? We don't know where the whole volume is, where all the buying pressure is. Hey, maybe Chase Bank bought up in here, right there. Maybe Wells Fargo's in here. Maybe Barclays is in here. Maybe whatever, right? So what we do is we look at this institutional candle. We look at the buy to sell candle, and we measure out the candle, and we look at where supply and demand meet, right? We got supply, and then we have demand. In regards to it, what I want y'all to take away from that is this, is where supply and demand meet is about the halfway point, and we call this the equilibrium. There's no guarantee when we're trading order blocks that the market's going to come to the 50% or not. But what we like to do is we like to create a zone from the open of this candle to the 50%. And this is where we want to look to get in and where we want to see price start to mitigate. What happens is if the order block is a solid order block, it took out some type of liquidity before making the aggressive move, changing direction, whatever the case may be. When price comes back to this area and they release these pent-up buying pressure, you got to think about you. If you have all this weight on your shoulders and then finally someone takes the weight off your shoulders, then you can relax. So when they release this pent-up buying pressure, the market will just continue on with the trend because it's released all that pent-up pressure, right? So this is a buy to sell example. Even easier way to clarify this, family, is just like this. A buy to sell candle is simply the last candle up before the move down starts. And then in the example of a sell to buy candle, it is the last candle down before the move up. Prime example, price is doing something like this. We have a break of structure. Price pulls back into our sell to buy candle, and then we start trading up. Sell to buy example would be something like this. we have our last bearish candle down before price puts in, let's just say, a bullish move, right? On a sell to buy candle, what we are seeing is very simply and easily put. We're seeing something like this. This is our order block. This is where the sells come in. So they sell here. When they sell here, they're pushing price lower. Maybe they're grabbing some liquidity, whatever the case is, to put in their real position, which is a buy, right? Buy. Now, once again, as this buy goes into profit, this sell goes into drawdown, and as price starts to form a retracement, what's going to happen is they're going to come right back into this candle, right back into this order block. We're going to measure it out. We're going to look for the key area in price. We're going to look to get in somewhere in the zone. And then from there, we take it higher to either the previous high, or the next high, or the next high, or maybe there's an imbalance up here. Maybe there's another order block, whatever, upside targets. It doesn't necessarily matter, but that is how you're going to identify them in the sense of the theory, right? Now, theory and reality are two different things altogether, but what we're going to do now is we're going to jump on the actual charts and we're going to look for an example of an order block and see how it plays out. So first things first is we need to identify all the potential liquidity points on this chart. I see these highs right here. I can say that there's liquidity sitting above them because this high did not go above the previous high, correct? And then I see these points here. This looks like equal highs because these highs, they're right in the rough general range. These are all roughly in the same zone right here, and none of them exceed the previous high. So they're respecting. So in regards to this, we also have some downside liquidity, aka these lows. Now, in regards to it, what do we see on this chart? We see price spiking these highs and then breaking structure to the downside. So what we have to factor in is hey, if this is to happen, what's happening here is a liquidity grab. There's liquidity sitting up above these highs here, and there's liquidity sitting right here. And then price even comes back up to a previous stutter candle right there, and then it hits it and it mitigates it perfectly. So we have to factor in is, hey, on some time frame, there is some type of order block. Now, the key thing for these order blocks is you want to find the volume candle. Now, here's a tip. Write this down. Volume candle. Some of you might call this the FU candle, whatever it is. This is the candle where you're looking at the biggest body to wick ratio. We want to surf through all the different time frames until we find the candle that is majority body and less wick. So we're scrolling and then boom, just like that. What do we have here? We have a candle that I would say is like 90 to 85% candle, and it's roughly what? 10% wick? That's probably the best candle we're going to find. We look at different time frames. We could even go to the lengths of refining it to this candle here, just because that is like that last candle that actually made that move up. The 2-minute candle looks good too. And we just refined it into this zone. Now, in regards to that zone, now what we could do is we could put a potential area where we would like to see price come back and retrace to. We have our optimal entry at the 50%, and then we have an entry at the open as well. And what we would like to see is it doesn't matter how long it takes or what happens. Right now, this is the high that put in a new low. So what we have to factor in is in the sense of our structure, our structures to the downside. It doesn't matter how long or how complex the pullback looks or whatever. If price can come up to this range, we know that this is an order block or an institutional candle that was driven up, grabbed liquidity, and then moved in the opposite direction very fast. So in regards to it, we could just sit back, and obviously this is just using the replay tool, but in regards to it, we could just sit back and wait for price to come up to this level and give us some type of opportunity to go lower. So right there, we have a hit at the open. Let's see if it ever comes back to the 50%. Boom. And just like that, hits the 50. And then Notice how it hit the open. Now we got to factor in a few different things. When you're trading an order block properly, once price comes to mitigate that order block, if it isn't really an order block, that mitigation move is usually very fast to the downside or the upside, depending on which way you're trading. So in this example, what I want you guys to understand is we found this candle on the lower time frame over here. Now, we didn't know which point where the volume really resided in. Notice how we hit the open and we had a reaction, but price came back up, broke structure once again, came up, came right to that 50%, triggered it, and that gave us the real reaction to the downside. And then we took out these previous lows. It was a beautiful setup. And those are some of the key characteristics to how to trade an order block. A lot of people, what happens is they also trade order blocks in the wrong way. Now, what I'm going to tell you guys is the key in aspect of trading an order block is to simply just wait for price to give you and show you its true hand. What does that mean? It simply just means that you want to wait for price to not give you a false move or a false trap, right? So let me give you guys an example of an order block that could be a trap. So prime examples, when we're trading, you could say, hey, this looks like an order block here, or hey, even this one here. You always want to look left and trade right. What does that really mean? It means that we got to always just focus in on what's happening to the left, right? If we look and we surf through all the higher time frames, what we see is there's a order block here on this time frame. Right here, we have the last candle up that created the huge move to the downside that also broke structure. When we look at price previously back in this range, what do we see? We see a higher low that puts in a highest high, right? We could say this is the higher low that put in this higher high. Or we could say this is the higher low that put in that high, higher low that put in that high, so on and so forth, right? But in regards to it, this point here is a major break of structure on this pair, major BOS. So my thought process is this is the last candle up before this huge move down that broke structure came into be. So what'll happen is sometimes you'll fall for these smart money traps. Smart money trap is just a trap to convince smart money traders to get into a trade or fool you into getting into something. So let's say here we had a move to the downside. Price comes back up into this candle, and what happens is right next to that candle, there's another candle right here. So what happens is, hey, maybe you say, hey, I'm not going to trade this candle. I'm going to trade this one. Maybe price hits your thing, triggers you a little bit, gets you going in your direction, comes up, stops you out, and then it goes back into your overall direction. That happens quite often when it comes down to trading. I can say that that's happened to me in the past where I had a zone. Maybe I thought, hey, maybe the highest point is a better zone. Price came through my zone, it triggered it, gave me a little reaction, and then it stopped me out. When in reality, you got to zoom out and you got to see the bigger picture. On this lower time frame, there's an imbalance here. On the higher time frame, we have that 3-hour candle. It's so many things that line up. So you don't want to fall for these traps either, guys. You always want to look at the highest candle and whatever point in price you're trading in. You always want to see the highest candle, the last candle up before the big move down starts. You always want to look at the candle up that caused the break to the downside. You always want to factor those things in. And same thing is in reverse. You always want to look at the last candle down that caused the bullish move up. So prime example, right now, even though we've had a reaction off of this high, we also broke structure to the upside. So until we see some type of break of structure, right now on GBP/NZD, this is that last candle down that caused this very big move to the upside that broke structure. Now we've made a retracement into a very deep area. In the next video, maybe we could see where this ends up. This is live right now in the market. We've hit the 50%, the 88.6. Potentially we could go higher. There's some divergence on this move too. Price is going like this. This is going down. Multiple confirmations on what could happen. But once you guys start seeing these things and you're following structure, you can start playing ping pong, trading down, catch an entry, trade up, catch another entry, maybe pull back, catch another entry, and keep it moving, right? The goal is to be able to play virtual ping pong on the charts and buy and sell and buy and sell all throughout the moves, right? Depending on the pairs you're trading, staying consistent with those pairs definitely pays out. With that being said, guys, this is going to be the idea and the concept of trading order blocks, and I hope you guys have enjoyed this part of the video. All right, guys, so we just got done breaking down what order blocks are, how to efficiently find them and use them, and how to maximize your results. And not just that, but we went over how to identify which order blocks to use, how to avoid the traps, and more importantly, how to stay consistent when it comes down to trading using this simple methodology. With that being said, guys, we hope that you enjoyed this video. Make sure you join the Discord. It's the first link in the bio. Above all that, we're going to be starting to do a lot more content here on YouTube. Like, comment, leave some feedback, and make sure you subscribe to stay tuned for the next one.